One of the most important skills for any stock market investor is to be able to analyze the price trends and patterns of different stocks. This can help you identify the best stocks to buy or sell based on the gradient analysis, which is a technique that uses linear regression to measure the direction and strength of a price movement. Linear regression is a statistical method that fits a line to a set of data points, such as the daily closing prices of a stock. The slope of the line indicates the direction of the trend, while the distance between the line and the data points indicates the volatility or deviation from the trend. A steeper slope means a stronger trend, while a flatter slope means a weaker trend. To perform a gradient analysis, you need to plot a trend line on a price chart, connecting the pivot highs or lows of the price movement. A pivot high is a point where the price reverses from an uptrend to a downtrend, while a pivot low is a point where the price reverses from a downtrend to an uptrend. You can use different time frames and intervals to draw your trend lines, depending on your trading style and objectives. A trend line can act as a support or resistance level for the price, depending on whether it is drawn below or above the price. A support level is a price level where the demand is strong enough to prevent further price decline, while a resistance level is a price level where the supply is strong enough to prevent further price increase. When the price breaks above or below a trend line, it signals a change in the trend direction. For example, if you are looking at an uptrend and you draw a trend line below the pivot lows, you can use it as a support level to buy the stock when it bounces off the trend line. You can also use it as a stop-loss level to sell the stock when it breaks below the trend line. Conversely, if you are looking at a downtrend and you draw a trend line above the pivot highs, you can use it as a resistance level to sell the stock when it touches the trend line. You can also use it as an entry level to buy the stock when it breaks above the trend line. Another way to use gradient analysis is to draw two parallel trend lines, one above and one below the price movement, forming a channel. A channel can help you identify the range of price fluctuations within a trend and capture more trading opportunities. You can buy or sell the stock when it reaches the lower or upper boundary of the channel, respectively. You can also exit your position when the price breaks out of the channel, indicating a potential reversal or continuation of the trend. Gradient analysis can also help you compare different stocks based on their trend strength and volatility. You can use indicators such as R-squared and standard deviation to measure these factors. R-squared is a value between 0 and 1 that indicates how well the linear regression line fits the data points. A higher R-squared means a better fit and a stronger trend. Standard deviation is a measure of how much the data points deviate from the linear regression line. A higher standard deviation means more volatility and more risk. By using gradient analysis, you can identify which stocks have stronger or weaker trends, higher or lower volatility, and more or less trading opportunities. This can help you optimize your portfolio allocation and risk management strategies. Gradient analysis is not a foolproof method, however, as it relies on historical data and does not account for future events that may affect the price movements. Therefore, you should always combine gradient analysis with other tools and methods of technical and fundamental analysis to make informed and profitable trading decisions. What are the risks and rewards of following the gradient strategy in different market conditions? The gradient strategy is a type of trading strategy that involves matching a long position with a short position in two stocks with a high correlation. The idea is to profit from the convergence or divergence of the two stocks' prices over time, based on their historical relationship. The gradient strategy can be attractive for traders who want to take advantage of market inefficiencies and exploit price anomalies. However, like any trading strategy, it also comes with risks and challenges that depend on the market conditions. Let's look at some of the possible scenarios and how they can affect the gradient strategy. Scenario 1. The market is trending up or down. When the market is in a clear uptrend or downtrend, the gradient strategy can be difficult to execute. This is because most stocks tend to follow the market direction, which reduces the chances of finding pairs that have a high positive correlation and a significant price discrepancy. In this case, traders may have to widen their criteria for selecting pairs, which can increase the risk of choosing stocks that are not truly correlated or that have other factors affecting their prices. Alternatively, traders may have to wait for the market trend to reverse or pause before entering new pairs trades. Scenario 2. The market is ranging or consolidating. When the market is in a sideways or choppy mode, the gradient strategy can be more effective. This is because there is more room for individual stocks to move independently of the market direction, which creates more opportunities for finding pairs that have a high positive correlation and a noticeable price discrepancy. In this case, traders can use technical analysis tools such as support and resistance levels, trend lines, and chart patterns to identify potential entry and exit points for their pairs trades. Traders can also use fundamental analysis to filter out pairs that have strong catalysts or news events that may disrupt their correlation. Scenario 3. The market is volatile or uncertain. When the market is experiencing high volatility or uncertainty, the gradient strategy can be both rewarding and risky. This is because volatility can create large price swings in both directions, which can either magnify or diminish the profits or losses from pairs trades. In this case, traders need to be very careful about their risk management and position sizing. Traders should use stop-loss orders to protect their capital from unexpected price movements and adjust their exposure according to their risk tolerance and trading goals. Traders should also monitor their pairs closely and exit their trades when the correlation breaks down or when the price discrepancy narrows. Conclusion: the gradient strategy is a trading strategy that can offer consistent and market-neutral profits if executed correctly. However, it also requires a lot of research, analysis, and discipline to find and trade suitable pairs in different market conditions. Traders should always be aware of the risks and rewards of following the gradient strategy and adapt their approach accordingly.